Welcome back to the Pro Ticker Podcast. It's Wednesday morning, and you know what that means.
Another deep dive into the major financial magazine headlines.
Right. There was a lot to unpack today, particularly those global market reactions to President-elect Trump's recent tariff threats.
Yeah, CNBC, The Wall Street Journal, Barron's, Bloomberg, they're all over it.
It seems like everyone's trying to figure out what these threats mean for the future of the global economy.
It's definitely creating some waves. You know what's fascinating to me, though? It's how these threats have had this ripple effect.
Oh, yeah, I totally agree.
Impacting currencies and stocks, of course, but even oil prices and consumer confidence.
Speaking of currencies, CNBC is reporting that the U.S. dollar fell to a one-week low as investors reacted to Trump's pledges.
The tariffs.
Yeah, 10% tariff on Chinese goods.
And then a whopping 25% on everything from Mexico and Canada?
It's a bold move. He's citing the flow of drugs and illegal immigrants as justification.
But the market's definitely jittery.
For sure. And the Wall Street Journal is highlighting economists' warnings about potential inflationary impacts.
Which could definitely complicate things for the Federal Reserve.
Right. They're trying to support economic growth while keeping inflation under control.
Exactly. They've been hinting at cutting interest rates, but this news might throw a wrench in those plans.
So it begs the question for the average investor. Are these tariffs a sign of a major policy shift?
Or just a tactic to get better trade deals?
Tough to say for sure.
One thing is certain, though. Uncertainty usually leads to volatility in the markets.
Speaking of volatility, CNBC is reporting that while the U.S. dollar is down, the Japanese yen has surged.
Reaching its highest level since the U.S. election, actually.
Why is that?
Well, there are a couple of things happening here.
Mhm.
One is the anticipation of a potential rate hike in Japan this December. Bloomberg's reporting on that. But more importantly, the yen is considered a safe haven currency.
What exactly does safe haven mean?
Okay, think of it like this. When investors are worried about global instability or economic turmoil.
I get scared.
Right. And they tend to move their money into assets that are seen as stable and reliable. The Japanese yen. With Japan's strong economy and history of financial prudence, it just fits the bill.
So when uncertainty spikes, like we're seeing now,
Investors flock to the yen, like seeking shelter during a storm.
makes sense. So while the U.S. dollar is taking a hit, the yen is benefiting from this global uncertainty. But what about Europe? They must be feeling the heat from these tariff threats as well.
They are. CNBC is reporting the Pan-European Stocks 600 index, which tracks a wide range of European companies, is trading lower as investors assess the potential fallout.
And to make matters worse, the Wall Street Journal is reporting that German consumer confidence has plummeted.
To its lowest point since May.
Anxieties over potential job losses and a looming recession are weighing heavily on people's minds.
For those who work in industries heavily reliant on exports, this situation paints a pretty gloomy picture.
It's not all doom and gloom, though, right? Barron's had this interesting article about how Ferrari is thriving amidst all this chaos.
Yeah. Ferrari is a great example of how a company's unique position can be advantageous during times of uncertainty.
They're kind of insulated.
Exactly. They have limited exposure to China, which is currently facing economic headwinds.
They're looking elsewhere.
Right. Seeing strong growth in other markets. And get this, they just launched a $3.8 million supercar, the F80.
A $3.8 million supercar.
Analysts are predicting that this launch could boost their share price by as much as 30%.
Wow.
It's a prime example of how a company can turn a challenging global environment into an opportunity for growth.
That's incredible. It seems like some companies are weathering the storm while others are making some tough choices. CNBC is reporting that Just Eat Takeaway, the food delivery giant, is delisting from the London Stock Exchange.
Citing low trading volume and administrative burdens as the reason.
It's a blow to the UK market, which has been trying to attract more tech companies.
Yeah, for sure.
What does delisting actually mean, though, for a company and its investors?
Well, essentially, it means that the company's shares will no longer be traded on that particular stock exchange.
Okay.
In this case, Just Eat Takeaway's shares will no longer be available on the London Stock Exchange.
So what happens to people who already own those shares?
Well, for investors who hold those shares, it could mean reduced liquidity, as it might become harder to buy or sell them.
So it's definitely a significant development for the company and its shareholders. This really highlights how each company is navigating this landscape differently. Speaking of navigating, how are different economies responding to all this? You mentioned earlier that there's cautious optimism in Singapore.
Yes. According to the Wall Street Journal, Singapore's central bank is confident in its financial institutions. But they're urging businesses and households to prepare for potential volatility.
They're saying be ready.
Right. In the face of global uncertainty.
It sounds like a measured approach. They recognize that the global economy is interconnected, and what happens in one part of the world can have ripple effects elsewhere.
Exactly.
And then you have New Zealand taking a very different approach. The Wall Street Journal reported that their central bank just slashed interest rates aggressively.
This is their second major cut in just a few months. They're clearly trying to stimulate their economy, which has recently stalled.
It's a bold move.
It'll be interesting to see how effective it is, especially given all the uncertainty surrounding global trade at the moment.
It seems like every country is trying to find its footing in this changing landscape. Okay, let's shift gears to oil for a moment. CNBC is reporting that oil prices are holding steady for now.
Markets are still digesting the recent ceasefire between Israel and Hezbollah, but all eyes are on the upcoming OPEC Plus meeting.
What's expected to happen at that meeting?
Well, there's speculation that OPEC Plus might delay their planned oil output increase. We could see a tug of war between supply and demand developing, and the outcome of that meeting could have a big impact on oil prices.
So it's a wait-and-see situation.
For now, yes.
It seems like geopolitical events, economic policy decisions, even technological advancements are all playing a role in shaping the market right now. Speaking of tech, the Wall Street Journal had this interesting piece about SoftBank investing a whopping $1.5 billion in OpenAI.
The company behind ChatGPT.
Right. It's a massive vote of confidence in the future of artificial intelligence.
It could significantly accelerate OpenAI's research and development efforts, potentially shaping the entire AI landscape.
What does this mean for someone like me who might be interested in investing in AI?
Well, it certainly suggests that AI is a sector with tremendous growth potential.
I see.
This investment from SoftBank, a major player in the tech world, lends further credibility to the idea that AI is going to be a transformative force in the coming years. It might be worth considering how you could incorporate AI-related investments into your own portfolio. We could explore that further if you'd like.
I'd definitely be interested in learning more about that later on. But right now, I'm curious about how another major player is adapting to the changing times. Bloomberg reported that ADNOC, the UAE's oil giant, is establishing a separate investment company.
Focused on natural gas chemicals and, interestingly enough, low-carbon energy operations.
It's a clear indication that the UAE is serious about diversifying its energy portfolio.
And positioning itself as a key player in the global energy transition.
They recognize that the world is moving towards cleaner energy sources.
And they're making strategic moves to be a part of that shift.
It seems like everyone is trying to position themselves for the future, whatever that may look like. But what does all this mean for the average investor like me? With global markets in such a state of flux, how can I make sense of it all and make smart investment decisions?
That's the million-dollar question, isn't it? We are seeing this complex interplay of geopolitical events, economic policies, and technological advancement.
All influencing the global economy.
Right.
And it seems like there are both risks and opportunities on the horizon.
Absolutely. We've seen how some companies, like Ferrari, are thriving in this environment, while others are facing challenges.
So how can I stay ahead of the curve?
The key is to stay informed, be adaptable, and maybe even be a little bit daring.
That's great advice.
Yeah.
Speaking of companies facing challenges, MarketWatch had a piece on Dell. Their story seems to be a bit of a mixed bag. On one hand, they're benefiting from the AI boom, seeing record revenue growth from their servers.
But on the other hand, they are encountering headwinds in the PC market. The transition to NVIDIA's new Blackwell chips and a slower than expected adoption of AI-enabled PCs are impacting their outlook.
So even a tech giant like Dell is experiencing both the benefits and the challenges of the rapid pace of technological change. Okay, we've covered a lot of ground today, from Trump's tariff threats and their market implications to individual company highlights and the global economic outlook.
We've also explored how different economies are responding, the varying approaches to economic stimulus and risk management, and how certain sectors like AI and low-carbon energy are presenting unique opportunities.
It's been a fascinating deep dive into the world of finance and economics.
It really has.
Before we move on to some other interesting developments, I want to leave you with a question to ponder. We've talked about how these global shifts are impacting companies and economies, but how might they ultimately reshape your own personal investment strategy?
That's something worth considering as we all navigate this ever-changing landscape.
Absolutely. Now let's dive into another intriguing development.
It really is a fascinating time to be an investor. There's so much happening, and it's all interconnected.
Speaking of interconnectedness, let's circle back to gold for a moment. CNBC is reporting that it's rebounding after hitting a one-week low earlier. It seems like the weakening U.S. dollar is giving it a boost.
Yes. And traders are also keeping a close eye on that key U.S. inflation data we talked about, looking for clues about what the Federal Reserve might do next with interest rates.
With interest rates, right?
Remember, gold tends to perform well when interest rates are low.
It does.
Mm.
It really highlights how one piece of economic data can have ripple effects across various markets.
Exactly. And speaking of ripple effects, let's shift our focus to Japan for a moment. The Wall Street Journal had an intriguing piece about their latest stimulus package. It seems they're considering a rather unique approach this time around.
Yeah, I read that article too. It sounds like they're moving away from simply throwing money at the problem and are exploring more innovative solutions.
That's right. Instead of relying on temporary handouts, they are considering boosting tax-free income
Tax-free.
as a way to encourage spending. It's a fascinating approach aimed at giving people more financial breathing room in the long term.
So the idea is that a permanent boost to income will have a more lasting impact on consumer behavior than one-off measures.
Precisely. However, there are potential downsides to consider as well.
Of course, there's no such thing as a free lunch. What are some of the concerns being raised?
Well, the biggest concern is the cost. Raising the tax-free income threshold would mean less tax revenue for the government.
Makes sense.
Some local leaders are worried about the impact this could have on their budgets and ability to provide essential services.
It's that classic dilemma, isn't it? Balancing the need for economic stimulus with the importance of fiscal responsibility.
It's a delicate balancing act for sure, but there are also economists who argue that this move could actually pay for itself in the long run.
Really? How so?
Well, the thinking is that if this policy does lead to higher employment and increased consumer spending, it could ultimately boost economic growth, which would then generate more tax revenue down the line.
So it's a bit of a gamble.
It is, but one that some experts believe could pay off.
It's certainly an interesting approach, and it'll be fascinating to see how it plays out. Okay, ready for something a bit different. Let's talk about Warren Buffett and philanthropy. Barron's had this intriguing article about what might happen to his vast fortune after he's gone.
Ah, yes, the legacy of the Oracle of Omaha. It's a captivating topic. Buffett has pledged to give away nearly his entire fortune, estimated at around $150 billion,
Wow.
through a charitable trust. And he's chosen his 3 children to be responsible for distributing this enormous sum of money.
$150 billion. That's more than the GDP of some countries. That's an incredible responsibility for his children. What are some of the challenges they might face?
Well, for starters, no foundation has ever had to distribute that much money in such a short time frame.
That's a lot of money to give away.
Buffett has indicated that he wants it all distributed within a decade or 2 after his death.
That's a tight deadline to manage such a huge sum of money.
It is indeed. It means they'll need to make some difficult decisions about which causes to support and how to maximize the impact of their giving.
And there's also the family dynamic to consider. 3 siblings, each with their own passions and priorities, trying to reach consensus on how to distribute billions of dollars.
It could lead to some interesting discussions, to say the least.
Yeah, I bet.
Buffett has stipulated that all decisions must be made unanimously,
Unanimously.
which could certainly lead to some lively debates.
What about Berkshire Hathaway Buffett's company? Will his children have any influence there after he's gone?
That's another intriguing aspect of this story. 2 of his children are already on Berkshire's board, and there's speculation that one of them, Howard, might become non-executive chairman after their father's passing.
So even though Buffett is giving away his personal fortune, his family's influence could still be felt at Berkshire for years to come.
That's certainly a possibility. It raises questions about how their vision for Berkshire might align with that of Buffett's chosen successors, who are currently led by Greg Abel.
It's like a real-life Shakespearean drama unfolding before our eyes. The passing of the torch, the distribution of vast wealth, the potential for family conflict, and the future of a corporate empire.
It's a compelling narrative, that's for sure, and one that we'll be following closely in the years to come.
Okay, so we've covered gold, Japan's innovative stimulus plans, and even delved into the world of philanthropy and corporate succession. It's amazing how much is happening in the markets right now.
It really is a dynamic time. It reminds us that the world of finance is constantly evolving, driven by a complex interplay of factors both domestically and globally.
And it underscores the importance of staying informed and adaptable in order to navigate these turbulent waters.
Couldn't agree more.
Before we move on, I have one more question for you. We talked about gold as a traditional safe haven asset. But given all this uncertainty in the markets, what are your thoughts on other potential safe havens? What about real estate? Or maybe even cryptocurrencies?
That's a great question, and it's one that deserves a deeper exploration. It's a complex topic with a lot of nuances to consider, but it's definitely something worth discussing as investors seek to protect their portfolios during these volatile times.
I agree. It's a topic many investors are grappling with right now.
It's all about finding those safe havens, right? Where do you park your money when the market feels like a roller coaster?
Exactly. And as you said earlier, gold is often seen as that classic safe haven. It's held its value for centuries, and people tend to flock to it when they get worried about things like inflation or economic instability.
It's tangible. It's not directly tied to any particular currency or government, which makes it attractive during times of geopolitical or economic turmoil.
Makes sense.
Yeah.
But gold isn't the only option, right? What about other traditional safe havens like government bonds?
Absolutely. Government bonds, especially those issued by countries with strong economies and stable political systems, are considered another popular safe haven.
They're seen as a more conservative investment than stocks.
Right. If you're looking for stability and a bit of a buffer against market swings, government bonds could be a good option. However, it's important to remember that even with government bonds, there's always some level of risk.
No investment is completely risk-free.
Exactly. So we've got gold, we've got government bonds. But what if an investor is looking for something with a bit more growth potential? Where does real estate fit into all of this?
Yeah, that's a good question. Real estate is often touted as a safe haven, and it can offer some protection against inflation,
Yeah.
but it's not as liquid as stocks or bonds.
Right. It can take time to sell a property if you need to access your investment quickly.
And real estate can be sensitive to interest rate changes.
Absolutely. If interest rates rise, it can become more expensive to finance a mortgage, which can impact property values.
So there are definitely factors to consider with real estate. Okay, let's shift gears to some of the newer asset classes that are gaining popularity. What about cryptocurrencies? Could those be considered safe havens?
That's the question that's sparking a lot of debate among investors right now. Some argue that cryptocurrencies like Bitcoin could be a kind of digital gold,
Digital gold.
a decentralized, non-governmental store of value. Can't be manipulated by central banks.
That's an interesting concept.
Hmm.
But cryptocurrencies can be incredibly volatile. Can something that fluctuates so dramatically in value really be considered a safe haven?
That's the million-dollar question. While cryptocurrencies have shown some resilience in the face of certain events like geopolitical turmoil, they're still relatively new and untested compared to traditional safe havens.
They haven't really been through a full economic cycle.
Exactly. Their value can swing wildly, and there's always the risk of regulatory crackdowns or technological disruptions that could impact their value.
So it sounds like cryptocurrencies are more of a high-risk, high-reward proposition than a true safe haven, at least for now. What are some other assets investors might explore if they're looking for diversification?
Some investors are looking toward alternative assets, like fine art collectibles, or even precious metals beyond gold. These can offer diversification benefits as they're not directly correlated with the stock market.
Diversification is always a wise strategy, especially when markets are uncertain.
Spreading your investments across different asset classes can help mitigate risk and potentially soften the blow if one area takes a hit.
So the key takeaway is to not put all your eggs in one basket.
Exactly. And remember, there's no one-size-fits-all answer when it comes to safe havens. The best approach depends on an individual's risk tolerance, investment goals, and time horizon.
And as always, it's a good idea to consult with a financial advisor who can provide personalized guidance based on your specific circumstances.
Couldn't agree more.
Well, we've covered a lot of ground today, from global market reactions to President-elect Trump's tariff threats to exploring the concept of safe havens for investors.
We've examined how interconnected the global economy is, how various companies are adapting to the rapid pace of change, and how individual investors can try to make sense of it all and navigate these uncertain waters.
It's been a fascinating deep dive into the world of finance and economics.
It really has.
We encourage our listeners to continue exploring these topics, stay informed, and make the most of the opportunities that arise even amidst challenges. We'll see you all tomorrow morning with new headlines from major financials magazines.